Hey, Alex, how much is a $500,000 home going to have for a mortgage payment? Everybody wants a simple answer, but without knowing more about you, what's your credit score? What programs do you qualify for? How much of the property taxes are on a given property? Does it have an HOA? There's no way to give honestly an accurate number on what that mortgage payment is going to be because there's too many components. We need to know more about you. I'm going to break down what your mortgage payment is comprised of and all the different components that feed into that so you can understand this a little clearer and also so you can protect yourself against, let's just say, unethical mortgage lenders. So when I say inputs, this is what I'm talking about. I'm talking about purchase price, which your down payment is going to be based off of. Say you're putting 5% down, results in a 475 loan amount. I'm going to keep interest rate the same in all of these examples. Property taxes, that's depending upon any given property and HOA. So first, let's break down what your mortgage payment is. It's PITI, principal, interest, taxes, insurance. It's the first four things here. So principal and interest is the easiest to understand. Principal and interest stays the same if you have a 30-year fix. Assuming you're making all your payments, it is the loan amount that you took out, interest rate, and however long. So the amount of principal and interest will change over the course of time. In the beginning, a lot less will go towards principal, more will go towards interest. And over the course of time, the amount going towards principal will grow, the amount going towards interest will decrease. But the total will always stay the same. When you have a 30-year fixed mortgage, this is what we're talking about when we say you have a fixed payment. It's just the principal and interest. Your escrows are things that can fluctuate. That's your taxes, your insurance, and PMI if applicable. So the way escrows work, we have to collect 1 month's worth of whatever the property tax bill is or whatever your insurance bill is per month. And I'll use myself as an example. I live in Frederick County, Maryland. I live outside of Frederick city limits. So unless it is a special case, I would expect that the property tax bill is going to be a little less than 1% of whatever the purchase price is. So I'm showing that here, $4,800 a year. But what if I were to magically transport that same home, same purchase price into Frederick city limits? Well, that property tax bill is going to go up quite a bit because not only has a county tax bill, but it's also got a city tax bill. So without changing anything else, watch what happens if that property tax bill goes up. Watch what your mortgage payment does. That's almost $300 a month payment. Again, nothing changed on the purchase price, your interest rate, but your mortgage payment went up because the property is located in an area with higher property taxes. And the opposite is also true. Let's say that I could transport that same home and it's the same price into West Virginia, where property taxes are usually about half of what they are in the state of Maryland. So let's say it's $2,500 a year. Watch what happens to your mortgage payment. So we're talking about a swing, depending upon where this property is located, of about $500 a month. And it's just property tax related. Insurance is pretty self-explanatory. You take your insurance bill, you're going to shop for your own insurance bill. We divide it by 12, and that's what we're going to collect into your mortgage payment every month. Now, where I want to make a quick note here is that if you're comparing lender versus lender, these numbers are only as good as far as how accurate they are. Meaning, let's say that you had a $4,800 a year tax bill, and let's say that I'm an unethical lender and I want to make my estimate look better. That we know the tax bill is $4,800, but maybe I only show $3,000 a month because I can claim that, hey, I didn't know what the tax bill was. And insurance realistically is probably going to be about $158 a month, but I'm only going to show $65. If you are only looking at that bottom number, what's my mortgage payment going to be? Again, nothing has changed here. That lender's estimate is going to look better because they put in faulty information. They underdisclosed how much insurance is going to be. They are underdisclosing what property taxes are going to be. And what's going to happen midway through the process, they're going to say, hey, we got the tax bill back from title. Looks like it came in a little bit higher. Did you shop for your insurance? Oh, it's a little bit higher as well. Okay, we'll adjust our figures and we're back to what it should have been. So don't fall prey to that common tactic. Unfortunately, I have seen that happen quite a bit. PMI, real quick. let's just assume that we're in conventional financing. I'm not going to get into all the other different programs, but you have a conventional loan. PMI is something that you're going to pay typically per month if you're putting less than 20% down. More you put down, less you pay. Higher credit score you have, less you pay, and vice versa. So let's say that you only are collecting $80 a month, but this person, I don't know what your credit score is, and let's say it's on the lower side. This $80 a month could turn into $275 with no other changes again to the loan parameters. It's just that you have a lower credit score. You're going to pay more in PMI. Let's say that you're putting 20% down. Once you put 20% down, two things. You see how your principal and interest changed? It's because you put more down. Lower loan amount over 30 years results in a lower payment. But then also your PMI drops off. So huge difference in what that mortgage payment is going to be just by virtue of the fact that you put down more and we don't have to collect for PMI. One note, I also want to touch base on HOA. So again, your mortgage payment is PITI, principal, interest, taxes, insurance. PITIA factors in your total housing expenses. This is important not just for you for budgeting, but also for us as a lender because we underwrite based upon and approve loans based upon what is your total housing expense for any given home. So again, same home, but let's say it's a condo and they've got a $600 a month HOA or condo due per month. Your mortgage payment is going to stay the same, but you are still going to be paying $600 a month. And we got to make sure that your total housing expenses are underneath a certain payment. So, if your maximum was only $3,500, but you found this home and the HOA is $600, something's got to happen. We got to get you under that $3,500 a month total housing expense. It's not that anything changed on the purchase price or the interest rate, just that this property charges $600 per month for condo dues. So that gives you a real brief overview of what goes into all the different components of your mortgage payment and total housing expenses.